We live in an internet of instant delivery. You can send a high-definition video to someone in Tokyo in milliseconds. But try to wire that same person $50, and you are suddenly waiting 3 days for the money to clear. This delay exists because of the double spending problem. When you send an image online, you aren't sending the original file. You are sending a perfect copy. If you could do the same thing with digital money, you could take a single online dollar and spend it twice at the exact same time. Without a referee to verify who owns what, a native internet currency would collapse instantly. For decades, the global economy has patched this bug using centralized middlemen. Banks and credit card companies act as the ultimate gatekeepers, holding a private master ledger to ensure that same dollar isn't spent twice. Because the master ledger sits in a single location, it functions as a primary target for hackers. A central authority also holds the power to freeze accounts, block transactions, and censor financial activity at will. Relying on these institutions creates a series of monopolistic choke points. The entire global economy depends on a handful of private organizations functioning honestly 100% of the time. In September of 2008, that institutional trust failed. The collapse of major banks exposed the fragility of a system built entirely on centralized ledgers. Right at the peak of this crisis, an anonymous entity using the name Satoshi Nakamoto surfaced on a cryptography mailing list with a proposal. Nakamoto published a 9-page white paper outlining a protocol for a peer-to-peer version of electronic cash. The document provided the first mathematically viable mechanism to solve the double spend problem without requiring a bank or a human referee. Nakamoto's solution was to invert the structure of the database. Instead of a bank holding a private master ledger, the ledger is made public. An identical, synchronized copy is distributed to every computer participating in the network. This continuous chain of records is the blockchain. To see how this works in practice, imagine a transaction between Alice and Bob. Instead of asking a bank for permission to move funds, Alice announces her transaction to the entire network simultaneously. She proves she owns the funds using cryptographic signatures, a mathematical proof that acts like a secure digital fingerprint, verifying the transfer without revealing her real-world identity. Thousands of independent computers then check Alice's transaction history against their own copy of the ledger. They look at her unspent balances to ensure she actually has the coin she is trying to send. Once verified, the transfer is grouped with other recent transactions into a chronological batch, or the block, which is permanently added to the historical chain. By universally distributing the ledger, the system protects itself. If a bad actor tries to forge a transaction, the rest of the network instantly recognizes the discrepancy and rejects the entry. If anyone can join the network, and there is no central referee, nothing stops a user from spinning up millions of fake computers to overwhelm the system and rewrite the ledger. To prevent this, the network uses specialized auditors called miners. To validate a block, these miners must expend massive amounts of physical processing power. This is proof of work. Miners compete to solve a complex cryptographic puzzle that makes the act of adding to the ledger difficult, slow, and expensive. The first miner to solve the puzzle and validate the block is rewarded with newly minted Bitcoin. This aligns cryptography with economics. To successfully rewrite the ledger, an attacker would need to control more than half of the global computing power on the network. Doing so would cost billions in hardware and electricity, while playing by the rules guarantees a financial reward. This architecture creates a strictly scarce digital asset. Bitcoin issuance follows a predictable schedule, slowing down until it hits a hard ceiling of exactly 21 million coins. This predictable supply contrasts fiat currencies, which have an essentially infinite supply, governed by shifting central bank policies. But absolute decentralization has a physical reality. Running the global proof-of-work competition consumes massive amounts of electricity, and the specialized mining machines burn out rapidly, leaving behind piles of electronic waste. There is also the friction of absolute ownership. Because there is no bank or customer service department to reset a password, individuals hold the entire liability for their funds. If you lose your cryptographic private keys, your wealth is inaccessible. High energy demands and unforgiving self-custody are not accidental bugs. They are the engineering trade-offs required to remove a centralized middleman from the system. Bitcoin has drifted from its original promise as a daily cash system into a highly volatile speculative asset. It is now frequently held in vaults as digital gold, rather than spent as pocket change. A technology built by cypherpunks to bypass Wall Street is now held in the vaults of the traditional financial system through institutional ETFs and regulated custody services. Regardless of its price or its eventual economic classification, the protocol demonstrated that a decentralized, trustless financial network is possible.